From the morning reading, buyers return as advancers lead headed into a three-day weekend. Bull flags galore. Trader's choice on Monday. 4 of 9 sectors moved higher on Thursday. XLE, XLK, and XLU were the strongest sectors, while XLG was the weakest sector. Oil futures fell by 20 cents to close at 39.59. XLV was 1.64, was the only positive sector for the 4-day holiday shortened week. XLE, XLB, XLF, and XLP lost more than 1% on the week. Breadth strengthened as advancers led decliners 1.04 to 1 on the New York Stock Exchange and 1.26 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:21 a.m. Central Time, and I'm recording this in preparation for the market day of March the 28th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive in to our morning report. And you'll notice right away that not everybody is back, and indeed, we have several markets that are just outright closed still for today, and what I believe they would call Easter Monday. And then also some of the data sources are also missing for today. So a number of people obviously were off for the long weekend and haven't quite yet got back up to speed. We ourselves were on vacation last week, so we're getting back into the saddle and up to speed ourselves, so we totally understand. In terms of the primary futures markets that we follow, in the S&P, you're up about 6 points at the time of this cut. Russell futures are up just under 0.5%. NASDAQ up about 1/3%, and Dow up about 1/4%. Crude oil futures were up about 0.4%. Euro at scratch. Bonds at down about 0.2%, and gold down about 0.4%. Some overseas markets that we follow were open. China is down about 0.7%, and Japan is up about 0.7%. So not a lot is going to come from the overseas markets to give us any guidance for today. And you see, as we come down into the macroeconomic reports for today, there's a whole bunch of these that are the French, German, Italian, Great Britain are all on bank holidays, so many of those markets will either be outright closed or in greatly subdued environments. In terms of our own reports for today, we have core price index, goods trade balance, personal spending month over month, and pending home sales that will come in after the market opens. So be aware of all that. In terms of looking forward, we have consumer confidence, and then we had Fed Chair Yellen speaking. So that certainly is on our immediate future. And looking forward to Wednesday to see if there's anything particularly big there. Now, obviously, at the end of this week, we have the beginning of April, and we'll start to see the regular monthly employment report and stuff like that start to come into play. We'll have to watch and see if they actually follow through with that on the first Friday, as is typical, or if they bump that to the next week. I think that will be this week, but we'll confirm that as we go forward. In terms of the current market conditions, we have some pretty benign conditions. You see the skew is below the warning threshold. Short-term VIX at 12.35. How long has it been since we said the word 12 with respect to a volatility reading? In terms of IP percentile, all these are also exceptionally low, all in the lower 1/5 percentiles. S&P at a 15, the Russell at a 20, NASDAQ at a 14, the Dow at a 9. So very, very compressed movement going on there. Also, look at this. In terms of the standard deviation moves, in the last 2 weeks on the S&P, there's only been one trading session in which we moved more than a one standard deviation move on a close-to-close basis. Now, the Russell's been a bit more active, but it usually is. Our mainstay, though, the S&P, we normally look for about 4 single standard deviation moves in a 2-week period. So very, very, very low volatility here of late. And we'll have to see if we get an expansion of that volatility at some point going forward. Now remember, just because you have low volatility doesn't mean that it's going to fire with more volatility the next day. It can go extended periods of time with low volatility. So something always to kind of keep in mind. But with the longer that goes, the more compressed that gets, the more likely we are to start seeing an expansion in volatility. We'll start with our SPX chart today, and you note that we have had something of what might be a topping pattern roll over at least into a retracement. At this point, given the big picture, we would expect this to just be a mild retracement and then set up another bull flag type pattern, and off you would go for the next leg up. And certainly we have resistance up here in the 2080 area would be the next significant area of resistance, and then followed closely behind that at the 2100, and then the 2116 is your all-time high in the SPX chart. If this is indeed going to be, you know, the end of wave 2 and the start of something bigger, then we'll look to see a break of this 1969 area. But anything that gives us a higher low, higher than this area, retains the expectation that this is just another bull flag, much like this one, this one, this one, this one, and now potentially this one, that it's just another bull flag and you continue to move higher. So your expectation should be in the intermediate term bullish until proven otherwise. In terms of the Dow, very much the same pattern. And the NASDAQ's been weaker on a relative sense of late, in part held down by biotech. Many people forget that many of the larger biotech firms are in the NASDAQ 100, so this definitely weighs down on the NASDAQ. So while XLV, the healthcare sector, has been weighed down not so much by pharmaceutical as it's been by its biotech components, the same is true for the NASDAQ 100. So it's not so much our pure tech play that we think of that's holding this down so much as the biotech. But it's also still in an intermediate term bullish pattern, and you would expect to have a bull flag here and a continuation higher until proven otherwise. Then the Russell also decidedly weaker, and while it's broken out of the cloud and you know, did everything it needed to do, it has been very much in a sideways pattern ever since. You had this breakout right here, which looked like, okay, we're setting up to go higher, and then immediately just kind of failed from there. So I suspect that we could even see that this might even be in a squeeze at this point. Certainly, this is in a sideways consolidation pattern. I would draw a box around all this action, and until you get a breakout of the top or the bottom of the box, I think I would probably consider it just to be sideways. I suppose you could start to draw a bit of a channel. You've got a little bit of a higher high here and a little bit of a higher low so far. Maybe we have a channel which is slightly bullish, or perhaps we have something that's more of a rectangle and sideways. We'll have to probably get a few more days to see how this plays out. But certainly to say that this is short-term bullish or bearish would probably be a mistake. In terms of volatility, we talked about how volatility has been coming down, and even on the futures, you know, you're currently trading at somewhere around 17.2. So these are definitely coming down into what we call the bull range, that range between 12 and 18 where the bull markets typically reside with their volatility. And we're back in that range, so we'll see if we can start to continue to ebb down and perhaps get below 15 on our VIX futures. In terms of gold, after having really set up and broken some really important long-term trend lines, has gone into something of a consolidation pattern itself. It was very poor form to break this diagonal support line on earlier in the week. I guess that would have been Thursday, probably Wednesday there, that it broke down through that in a very decisive way, broke a number of supports, not just diagonal support and the one that I'm inferring here, but also horizontal support, in that it closed below this recent swing low. So this is a poor kind of retracement, if that's what it is going to turn out to be, because it's moved through a number of levels of support, and it kind of calls into question whether this whole move might be getting something deeper in terms of a retracement. So we'll continue to watch the gold markets. And then bonds. We'll wrap up with bonds. Bonds, much like much of the indices, seems to have gone sideways and not leading us anywhere. And you notice it's in the cloud now. That's the definition of chop, and certainly not giving us a strong sign one way or the other. That should be enough on the charts for today. Let's go to the daily report. And in terms of our market trend, intermediate term phase opinion, we're still phase 4. We've been phase 4 now for quite some time. This is a bullish phase with price patterns near horizontal resistance, a mix of bull flags and other kind of bullish type patterns. In terms of our mechanical signals on portfolio investor posture, the first one from IBD, confirmed uptrend. Accumulation distribution score on the NASDAQ, a C-, on the S&P, a B-. Those don't sound sterling, but those are so much better than they've been for such a long time. GMI index also comes in with a buy signal on a 5 out of 6 score, and it's been in that buy signal since March the 2nd. And then our third mechanical signal from stock charts, decision point scoreboards, note that the short term has been joined almost universally in the intermediate term with bullish signs at this point. Only that long term is still down. But given that we have now a stack between the short and the intermediate term, expectation is that this is going to be bullish until proven otherwise. Now, if we start to break down, we'll start to flip these signals, and they'll just turn out to be a false breakout. But as it stands right now, this mechanical signal is starting to go into more of a bullish stance. Now, it's not a happy-go-lucky, everything goes in and without any risk concerns when you have this long-term stance still as bearish. But we generally trade off the intermediate term time frame, and then when you take the consensus of these various signals, it's clear that that intermediate term time frame is now clearly on the bull side. In terms of portfolio investor position sizing opinions, both systems, both the portfolio and the active trader based on volatility, are coming in at 100%. Intermediate term market posture on all 4 indices is strong, very strongly bullish on all 4. You see they're all up over 90. We have a weak bullish sentiment line, but an improving sentiment line. So we're still expecting that bullish swings to the market will be longer and more pronounced than the bearish swings. In terms of the strength of the trend, right now it is weak but significantly improving. We'd like to see this get back up over 80 and kind of like this kind of run. That's a much stronger bullish trend when you're up over the 80 on that particular indicator. In terms of hedge warning status, we retain the 0+, which is normal, with some elevated risk conditions, and frankly the number of elevated risk conditions right now are fairly low. In terms of special opinions from our strategy setups, option income strategies, the VIX is inside the acceptable window to initiate new positions for even novice traders. So you should be pretty much working your option income strategies per your normal trading rules. In terms of cover call strategies, a couple changes here. Conditions are acceptable to initiate new positions for novice traders. Traders might want to consider using a 2 to 3 ratio of in the money versus out of the money strikes. So becoming increasingly bullish here. and not quite 1-to-1, a little bit heavier than 1-to-1 on those out-of-the-money strikes. So depending on how many shares you purchase, consider how you might allocate those strikes. Note, though, that we're not all bullish. We still have some defensive aspects to this, and also this is reflected in the mix of lower beta versus higher beta portfolio positions. We're definitely bringing in more of a mix of higher beta exposure, and yet at the same time we're not leaving the investment in lower beta positions. We're just mixing in more high beta than what we've had previously. If you're looking at something that's particularly aggressive, you might consider legging in, using well out of the money put selling to build a position. Again, this market, while increasingly bullish and increasingly showing signs of strength, is not out of the woods by any measure. In terms of our special warnings, you see everything's in pretty good shape. Volatility ratio warning has been flagging, and we're still waiting for that close back inside that signal system, so kind of keep that in mind. It's firing. And then also note that the distribution day count on the NASDAQ has now hit a 5, which is a warning status on that setup. Everything else is looking pretty good. Now, the intermarket risk aversion indicators, they're the other area that we're seeing some warnings. We've had 3 of these now roll over into risk off, and the remaining 2 are still in risk on position but are clearly rolling over. So these are sometimes some of the more sensitive indicators to tell us that things might be rolling back over. So not a lot of warnings here, but certainly there's some, and we don't want to ignore these leading edge signals. In terms of sentiment indicators, of course, what we look for here is extremes, and nothing really terribly extreme at all. Only LQD, in terms of the individual symbols that we were watching, has a particularly high sentiment right now, and at that point we just simply watch for potential reversal patterns. The fact that the sentiment is high is in itself not a reversal signal. In terms of intermediate term market posture, you'll see there is a long list here and a very long mix of both high beta and low beta sectors in play here, with their intermediate term market postures now in the bullish position. In terms of other sector specific information, our percent change, we see that for Thursday, it was frankly kind of a mix of higher beta and lower beta. Utilities is still in here. Telecom is the best performing, while energy and consumer discretionary, also were in the top of the stack, though albeit not, as strongly bullish. In fact, we probably would say that Thursday was a bit leaning towards the defensive, with utilities and telecom being 2 of the top 3 sectors. In terms of market posture, you can see that pretty much green across the board, with the exception of telecom, energy, and financials. And particularly financials, we'll want to continue to watch that. It's very hard for a healthy bull market to persist without the full participation of the financials. And you can see they're kind of a neutral stance across all 3 time frames, so certainly not doing anything that would make you want to make a big case for the bulls. So I think, we got one more here. In terms of the relative rotation graph, we see that utilities and IYZ, which is telecom, continue to be the best performers, and that they're the ones that are occupying the upper right quadrant. Though note that the utilities has been kind of tailing down. It's still in the right place, but it's been certainly kind of tailing down a little bit. And then note who are coming on. IYT and XRT. IYT is transportation, and then the XRT, of course, is retail. And then ITB also coming into play. This is home construction. It's now come up into this upper left quadrant, so improving, and maybe something that you want to take note of in your watch list, especially taking a look at some of the better performers within these components. Okay, I think that's probably enough for today. As as you and probably many other traders are kind of getting back in the saddle and back into the routine of things, we, of course, always greatly appreciate your feedback and participation. One of the ways that you can participate is to sign up to get our limited number of emails. We typically send out, you know, just a handful in a course of a month. A lot of times there are alerts to hedge risk level changes, and then every now and then we write a blog article and the like. If you'd like to be part of that, just go to this website, falconglobaltraders.com/blog. Scroll down just a little bit. You'll find this button here, and click on that button. That'll ask for your first and last name and your email address, and then that'll get you signed up. That'll also give you a hyperlink to get a copy of the free ebook Portfolio Strategy. If you like to do this through the smartphone, you can just text Falcon Global to this number here, 22828, and that will also get you into the system. You can also, of course, like us on YouTube, retweet us to your Twitter followers and to your StockTwit followers. Those are always very much welcome. Now I'm at 20 minutes now. I'm going to go ahead and start scrolling forward. One thing, of course, as you note on these various opportunities, is with the YouTube, if you just hit that special gear, you can actually speed this up and listen to this video each morning at about 1.5x, and that will often cut this down to about 13 minutes and still allow you to fully understand, you know, what is being said each morning. Disclaimers, as always, hit the pause button if you need more time to review. You note the full hyperlink at the bottom to take you to the full set of disclosures. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.